Once again, this is exactly like the old switching test of various kinds of support and resistance lines. Beyond fair value gaps, ICT's method also points to other types of related concepts, namely volume imbalances and gaps. A volume imbalance happens when there is a gap between the open and close of adjacent candles, although there is trading activity within the gaps since candle shadows overlap. A gap occurs when there is a space between highs and lows of adjacent candles, meaning there is no trading activity between the high of the first candle and the low of the second candle in the case of a bullish gap, or the low of the first candle and the high of the second candle in the case of a bearish gap. In this illustration, you can see the bullish version of the fair value gap, volume imbalance, and gap side by side for comparison. In this other illustration, we have the bearish version of all three patterns. Keep in mind that you can use fair value gaps, volume imbalances, and gaps in a similar way. Let's now observe some real examples of fair value gaps, volume imbalances, and gaps, starting with a very simple example. We begin with this 1-hour chart of the dollar index. Moving one candle to the future, you can spot the formation of a fair value gap since the upper shadow of this candle does not overlap with the lower shadow of the current candle. It's not uncommon for price to return to the fair value gap and then continue its main trajectory.